All right, everybody, this is the first rollover for the El Toro trade. Today is February 14th. Hey, happy Valentine's Day. Will you be mine? So it's been 1 month. These are trades that we put on the 15th of every month. And these are just like super set and forget trades. We just put them on and then we just don't even have to look at it unless there's something going on with the market. If the market starts to tank, like if we see it in the news, something going on, or we see that the stock market's crashing, or we can check in on these if we want, like as many times as you'd like, but you really don't have to. I've found that like once a week, twice a week, maybe every other day, just kind of take a look at it, see where it's at. And most of these come out winners. If you look at the training that comes in this module, it'll show you exactly the how the whole thing works, how we put them on, why, the when, why, what, and where, and all that. And I also did some videos with where I do back tests. I go back through the entire previous year. And on the SPX, this trade performed really well last year. So this year I decided to go ahead and just put an actual live trade on every month, one contract, and we'll just document the whole thing. So that's what this video project is all about. And this is the first trade that I put on in January 15th. And I put on 3 variations of this, which I'll continue to do just so we can kind of see how each of the 3 different variations play out. And what the variations are, here's the actual trade that I put on. This is about 30 days ago, January 16th, I believe. We put these on around the 15th. So the first version or variation of this trade that we're going to monitor here is just the spread, the credit spread by itself. And again, all the rules for this is in the corresponding video that's in this module that just goes through the whole strategy, how it works, and the back tests and all that. But here is the basic version, which is just the credit spread by itself. So this trade, we're risking $750. And for this month, we're up to, right now, what we're gonna do today is we're gonna take this trade off just at wherever we're at, and then we're going to put a brand new one on. We just do that every month. Every 30 days, we just roll it. So even though there's like another 30 days left in these options, we put these on at 60 days out with options that are 60 days till expiration. And then at day 30, when they've like lost value for over a month, halfway through the whole life duration of the option, then we just take them off and we put a brand new one on, and we just keep doing that over and over and over again. So that's where we're at with this trade. We're going to take this trade off today, and we're going to put a new one on. But let's just see what the return is for this month on this. So let me pull out my calculator. So the risk on this was 750, and the return is going to be around 150. So let's say we made 150 divided by 750. Equals 20%, which is not too shabby for a 1-month return. And if we times that by 12 months, we're on track to make a 240% return. Is that right? Holy moly. But throughout the trade, I'm expecting to have a couple of trades where we'll have less of a profit or break even or even a loss. And the stop losses and all that info, all the rules for this trade are again in the video, the corresponding video that you'll find in this same module. All right, so that's variation 1, just the basic trade by itself. Now the second version that I'm going to be monitoring here is where we sell, I call it like a booster, a premium booster. It's where we sell a put spread further down just to bring some more premium into the trade, boost the whole thing up. It's a little bit riskier, but if you have your eyes on it, you manage it correctly, I don't think it'll cause that much of a problem. It's just as long as you stay on top of it. So again, this is the second variation. And what that trade looks like is this. And let me just break these apart. So this is the basic version, which is the same. But I just added I sold a put spread further out, further down, brought in an extra dollar worth of premium. And then combined together, you can see that it builds this kind of this stair step. And this put spread could be taken off early if you wanted to, just to try to get some premium out of it during the first week or so, and then take it off. Let's see what that thing is, the value of that is right now. So right now, we brought in $100 worth of premium. I could remove this and get 60, so a little over 50% on that. But the plan for these videos is to just not really manage these unless we have to, meaning if there's if we exceed our stop loss on the trade, then we'll get out of these. So let's look at this again together. So with this little booster in here, The return is we made $200. We'll make $209 after I take these off. So let's see what the return on that is. Our risk is more on this one because of that booster. $215 worth of profit divided by the risk, which is $11.50, is a little bit more on this one because of that booster we stuck in there. So divided by $11.50 gives us a return of 18.6. So it's a little less than the variation, the version just by itself, which is interesting. Okay. All right. Some of that may have to do with just where we're at on the chart with the SPX right now. Like, for example, had we gone up, if we ripped a little bit higher, this could have taken all of the premium out of it. We could have drained all the premium out of that potentially and then removed it. But the way that it stands today on our roll day, it's going to be like it's going to be $215 worth of profit, or 18.6% return on the month. Let's say times 12. Let's see what the annual return on that is. 224%. Not too shabby. But again, I'm expecting to have one or two trades throughout the year where we're going to have to remove this at our stop loss. So let's not get too excited and count all our chickens before they hatch on that one. So the third version is where I just placed a naked put. I bought a naked put as a hedge, just kind of a basic hedge on the whole position. And you can see what that turned on now. That's like not really showing much. When we put this on, there was more of a protection at that point. That was 30 days ago. So if there was a big sudden crash down, the put would, the volatility would, explode potentially on a big enough move, and this could be worth a lot of money. And just this pink line could curve up, and maybe not get us into profit. It could potentially, if it was a big enough move, but it could kind of even out the, just kind of flatten the whole pink line out, and so we don't suffer as big of a loss, or we have time to react and take the whole trade off without, scrambling and panicking and all that. So with all three on, the booster, the regular spread, and this hedge, we're looking at a return of 139, 140-ish. Let's see what it is with just the regular hedge just the regular spread by itself. So here's the regular spread without the booster. If we had that hedge on, it would have given us a return today of, instead of 150, it would give us $80. So you can see the hedge there really kind of dragged on that one. The worst we could lose on this is the price of the put, which is $95. Right now, we've lost $69 on it. So over 50% drainage on that. But during the first week or two, that hedge would have been really useful if we needed it. I don't know about right now. Let's just see what happens if we pump the volatility up. If there was like a big crash today, let's say the volatility would go up, let's say 25%. Oh, it's not letting me do it. Come on now. What's going on? 25? I've run into this before where it makes me type this in. Let's see if I can do it now. 25. So 25%. Okay, so there's an example. So maybe it would be. Here is an example of if there was like a big crash, volatility went up by 25%. You can see the pink line just totally raises up, and even where we're at, it's more than we could expect to make at expiration on this. It flattens it out, and I think on a crash, like a real crash, I think the volatility would go by 25%. I don't think that's overdoing it, but just to be super conservative, let's change this to a 10% boost in volatility. So even then, you can see that it helps. So I take back what I said. Maybe it could be useful throughout the whole duration of the trade, even up till today, if there was a crash. So with a boost of 10% in volatility, if there was a crash today, without it, let's say we came down to 5,800, we would be down $177, which is pretty close to our stop out point, our stop loss. But had we had that put on and the crash happened, you could see at the same point we would be down 100. So that could help significantly. And if there was a huge crash, like just totally bonkers, you can see that pink line starts to come back up. And eventually, if it's far enough down, if it's like a super crash, the put alone could put the whole position into a profit down there. So if you'd like to learn more about this trade and all the entry rules, exits, adjustments, stop loss management, out points, tricks and tweaks you can put on them, plus a bunch of other really cool trading strategies that are similar to this that I trade every day with real live money in my Discord, just reach out to me directly. The easiest way to get a hold of me is just to go over to my website, sign up for my free email newsletter. I'll leave a link to my website in the description below. Just click on that link, go over there, sign up for the free email newsletter, and as soon as you do that, you'll get a welcome email sent out to you. Just reply back to that welcome email and say, hey, hook me up with that El Toro trade and everything else you got. I'll get back to you and we'll go from there. All right, that's it for this one. See you tomorrow.